Okay, good. All right. Well, thank you, Jason and Sarah, for having me. The DoorGrow folks over here have been gracious enough to let me have a few minutes of time here to present some non-QM loan options and just discuss a little bit about how, you know, investors can leverage these products to grow their portfolios and just really more information about the products themselves, but yet with the overview of just understanding how investors can leverage these products. So without any further ado, my name is Matt Dean. I'm with Nexa Mortgage. I've been a licensed mortgage loan officer since 2003. Some of the titles that I've had in that time is branch manager, sales manager, worked for a builder, a production builder, managed private money funds or co-managed. I still have access to some of that private money here in Austin with some folks that I've worked with for years and still have great relationships with. I've owned investment properties, managed them myself, and today I'm really just an independent broker with Nexa Mortgage. And to go into that just a little bit, Nexa is licensed in 48 states. We do have access to about 200 wholesale lenders. We do conventional loans, jumbo loans, FHA, VA, pretty much the whole gamut of loans, in addition to commercial non-QM loans that we're going to talk specifically about today, rehab and private money loans as well. And so really, one of the benefits of Nexa or being an independent broker is just the wide depth of product that we have. And so we've got, a lot of different options with some outside the box programs that can really help get some of those loans that are a little bit tougher approved. Today, I just want to talk a little bit about non-QM loans. Really want to answer the questions, really just kind of define what non-QM loans are, how they started, what that really means. It means, non-qualified mortgage, but we'll try and answer the questions of, what exactly are non-qualified mortgages, the history of them, why that segment of the market has really become the fastest growing segment in the mortgage market. What type of different non-QM loans are available. We'll talk about some of the differences, the advantages and disadvantages of those loans. And then also, again, as an investor, how can you leverage these programs to really help you either, grow your portfolio or in some cases even get approved at all. So that's kind of the overview of what we're going to look at today. Can everyone hear me okay, by the way? Am I loud enough? Okay, great. So really just the history of it. In 2014, after the crash of the real estate, market in 2007, 2008, the CFPB was organized really to try and mitigate risk within the lending environment or within Fannie Freddie conventional loan segment. And so they came up with, regulations to help mitigate risk. And that part of that was the ability to repay rule. So all conventional loans now fall within what's called QM or qualified mortgages. In order to sell those loans to Fannie or Freddie, they have to meet certain requirements, really based around consumer protection. But, if you're a borrower that doesn't fit inside that box, then you have potential problems of getting approved. So that kind of created the non-QM space. So anybody that falls outside of that qualified mortgage guideline technically is a non-QM loan. Jumbo loans historically have been considered non-QM or non-conforming loans. So that's kind of been a loan that's always been outside of the conforming box, secondary markets to sell those loans. So non-QM started at that point in time. Initially, lenders were a little leery of jumping into that. They didn't really have a whole lot of resources to sell those loans on the secondary market. A lot of the banks were hesitant because they were required to have additional reserves for every loan that they funded or non-QM. So it took a few years before it really kind of took off. In the last few years, we've seen tremendous growth within that segment because there's now a lot of avenues to deliver those loans on the secondary market. And a lot of, investment banks and mortgage broker bankers are seeing this as a big segment of the market. It's also, growing because Fannie Mae is pushing loans away from, in a sense, they're pushing loans away to try and mitigate some of their risk. They'd rather some of these loans go to the non-QM market. So again, QM stands for qualified mortgage. This is a loan that's historically been used to purchase investment properties. They do have specific guidelines. You got to kind of fit within that box. And the ability to repay, which is a big piece of that, has to be met through full income documentation. So if you're doing a conventional QM loan and you're self-employed or own investment properties, you're going to be required to provide tax returns, W-2s, pay stubs, in addition to assets for down payment and reserves. Under non-QM loans are really the ones that fall outside of that, which means that we can get we can utilize alternative documentation to provide or to satisfy ability to repay. So what is that? That could be bank statements, business bank statements. It could be CPA prepared statements, P&L statements. It could be rent from the subject property itself, commonly referred to as DSCR. Or it could be assets that we convert into an income stream. So that's really what we're looking at as far as the alternative from a tax return perspective, which, you know, the benefit here really is if 9 times, or I'd say 8 out of 10 self-employed borrowers that have investment properties are typically showing some sort of losses on their schedule, on their tax returns, right? So by design, they have CPAs that are trying to offset income, minimize taxes. And so by design, they're showing very little income or losses in some cases. And that's really where we run into problems with QM and why these products kind of step in or can come in and help those type of borrowers. So QM, conventional funding, again, is Fannie, Freddie. They have risk-based credit adjusted pricing. I'll go into why that matters a little bit here in a second. It is full income documentation, meaning we have to have tax returns, W-2s, pay stubs in order to qualify. The challenges with self-employed borrowers or investors under a qualified mortgage is, you know, again, like I just mentioned, often they do have losses on their business themselves, or even on, let's say they've got 4 or 5 rental properties, are showing losses on those rental properties. We have to look at the net income from the tax returns on those type of loans. Oftentimes we may have debt ratios that are a little bit high, where non-QM can come in and have an expanded ratio product or no ratio product that would help that. Credit score adjustments with Fannie Mae. In the last year and a half, Fannie Mae basically increased their loan level pricing adjustments for credit scores. And basically what that means is that now investment properties that already had really high risk adjustments were increased. And so, again, in my opinion, they're trying to push some of that paper to these non-QM, but really what that means is that if you have a lower credit score and you're adding that on top of the risk adjustment for the property type, there are cases where it's impossible for us to even meet QM guidelines, because the points that would have to be charged to even do the loan then put us out of QM range. So again, it's just some of the adjustments within the Fannie Mae product or the QM product are now making it to where some of these loans are being pushed to the non-QM market. So again, reserve assets can also be a challenge with conventional loans. I'll go over that in a little more detail here with non-QM. And also conventional loans don't allow any sort of LLC financing, which is attractive to some investors that really want to, you know, mitigate their risk. And a lot of people want to put their properties in LLCs. So conventional loans aren't going to allow that. There are ways to do it, but there's some challenges or some things you need to be aware of if you're going to go that route. So really, like I said, the reason that Q or non-QM is really the fastest growing segment of the market is that it's filling a void that Fannie Mae has kind of created with QM and also with their loan level pricing adjustments that they implemented about 1.5 years ago. So those additional adjustments on the credit score and also the property types, again, are just making it more difficult for for self-employed borrowers and investors to get qualified under QM. And so it's just pushed more of that paper and driven a lot of growth in this segment of the market.
Hey, Matt, real quick, just by show of hands, everybody, go ahead and put, or just comment in the chat, actually, if you are familiar with non-QM loans, or not, just to kind of take a temperature of the room. And just everybody comment, yes, you're familiar, or no, you're not familiar, just so we kind of gauge that. And if you have any questions, make sure also to throw them in the chat, because this is a great opportunity to ask a consummate expert in this questions related to this, because I think this could really benefit your investor clients and get you more investors, or get your investors to be able to get more loans or get other financing to get into more property, which I'm sure they would want to do outside of the conventional lending. So, okay, cool. We're getting some feedback here. All right, go ahead, Matt.
Yeah, good stuff. That I see a lot of people aren't familiar. That's really, good to know that we're kind of bringing this to the forefront here, and kind of at least educating some of you, at least, that these products exist. So that's great. I lost my ability to move here. Yep, maybe. Okay. So I'm going to talk about the four main types of non-QM loans. There's some others that are these are really tailored towards the investor purchase. There are some products that are tailored more for primary residence, but I didn't really include them here. But really, we have four main ones: business bank statements, DSCR, what's considered rental property or rental income only, asset-based, and then P&L only loans. Those are really the main ones that I look at when we're trying to qualify investors. So what is a bank statement loan? Bank statement loan is really for self-employed borrower who has challenges, like I said, qualifying via full income documentation, or we can look at 12 to 24 months business bank statements. So instead of looking at net income on the tax returns, I'm now looking at the gross income of deposits coming in. And then depending on the industry that they're in, there's an expense factor. So it could be anywhere from 20 to 35%. The lender really kind of determines that based on the business. But then if we back out 20 to 35% of those gross deposits, that's the income that we can qualify. And it's essentially considered full document, or full income documentation. So it's a little bit better program, or has a little more flexibility than if you just do a DSCR, meaning you could potentially get to a little bit lower down payment, possibly a little bit lower interest rates if you go that full doc versus no ratio, or DSCR, which is rental income only. So next one, DSCR, rental income only. What does that mean? That means that we're looking at the subject property as a rental property, and the only qualification is that the rent or projected market rent on that property is going to cover the full payment, including principal, interest, taxes, insurance, and HOA fees. So that's really what we're looking for. We'd like to be at least 100%, meaning, $2,500 payment, $2,500 rent. If we're 120%, then you can get a little bit better pricing in some cases. And if we fall below that, we do have lenders that'll go down to 75%. But as you fall down into those categories, it's typically going to require, higher credit scores, maybe a little bit more down. So there are more ways to work with that. Or if we run into a situation where market rents just aren't going to cover, but we do have the down payment, we do have what's called a no ratio product, which basically eliminates the ratio calculation at all. So again, DSCR, debt service coverage ratio, that is looking at 100% rent income. This could be long-term rent from an appraisal, or it could be short-term rent. We also do these for short-term rentals. The big part of that is that I do have lenders that will look at short-term rental from a software standpoint, and not necessarily be leaning on the appraiser for those numbers, which is very big in my opinion, because sometimes the appraisers just don't have the data. Putting together short-term rent analysis is not something that appraisers have historically done. They've only looked at it from a long-term basis. So this is something that's fairly new in the last couple of years, looking at short-term rental income. They're getting better at it. Some appraisal management companies are definitely better at it, that have really focused on working with some of these non-qualified lenders. But if we can determine that short-term rent number upfront through the software, it eliminates some of the surprises later. And so we're not waiting 2 weeks to get an appraisal to find out that, oh, our rent doesn't cover and now I need more down payment, or I got to go to another product. So it's just it's a convenience factor for on my end to basically determine the product to the buyer up front without any surprises. So again, this is how it's calculated. I just kind of gave an example here. PITI is $1,200. That's principal, interest, taxes, insurance. If we had a $1,500 gross rent, that would put us at 125 ratio, which is, whoops, sorry about that. Which is where we would prefer to be. 120, 125 is great. 100's, ideal for most products. If we fall below 100% coverage, then we've got to look at some alternatives, typically of additional money down, or potentially taking it to a no ratio type of product, which may have a little bit higher rate. So again, we can go down to 75% if we have just a rent, that's well below the PITI on there. But the higher the debt coverage, the better the terms are going to be. Asset-based loans are the fourth one here. Now, Fannie Mae has this product as well, just FYI. If you can meet Fannie Mae guidelines to use assets as income, then it is available as well. The difference being that you still have to meet all the other requirements for Fannie Mae, which would be additional reserve assets on your properties. And we still have to look at a lot of other things that would fall under QM that makes it a little bit more difficult. So asset-based is really on the non-QM side. I've got several products, but we're really taking the net worth or the liquid assets that you have, and then using a formula to turn that into a monthly income stream to qualify. And then that's basically considered a full doc loan. So when we look at, I'm going to talk a little bit about the no ratio that I've mentioned here. Whoops, sorry. No ratio is another product within this, meaning that I probably should have listed it as another one, but if we go to a no ratio, that just means the lender's looking at credit, down payment, and no income for rent. So it's basically, we're eliminating that the rent calculation altogether. So again, this comes into play if we get an appraisal and the rent comes in low and all of a sudden we don't meet even say 75% coverage, we at least have an option to get this loan done. We just have to flip it to what's called a no ratio. That typically is going to have a little bit higher interest rate. But it is available, and it is an option that, we always want to kind of have that worst case scenario backup available just in case. And then, whoops, sorry. I think I just talked about assets here a little bit, but I'm going to talk about that here in the next screen. So I'm going to skip by that. CPA propelled P&L statement. So this one is great if you can get a CPA that'll actually work with you, right? A CPA can write the letter, prepare the P&Ls, and give us the documentation. And then typically we look at like 1 to 3 months bank statements on the business to kind of validate that the income they're giving us kind of matches up. That can be challenging if businesses are seasonal. The biggest challenge with this is most CPAs don't want to write these letters. Unfortunately, they've been sued in fraud cases, and they just feel like, hey, if you want the information, get tax returns. So it's difficult to get CPAs to write these letters anymore. It used to be years ago, we could get them to do a lot of stuff. It's more and more difficult. If you have a really good CPA that's, feels comfortable about your business and have been working with you for a long time, sometimes you can get them to work with that. If we get that, then again, we're just working off the income that the P&L is prepared by, and then backing it up with bank statements, really documenting our ability to repay through that documentation. So again, how can you as an investor or a property management company that's sharing this with your investors, how do you leverage this, or what are the advantages? Really, again, we're eliminating personal income out of the equation with these loans in most cases. So no tax returns, no W-2s, no pay stubs required. That's the big thing if we're looking at, DSCR. If we're looking at bank statements, we're moving the the documentation from a tax return net income perspective to a gross income perspective from the tax return. So that's either 12 to 24 months. And then we're using an expense factor, but that will typically eliminate, negative income that we see or have a problem with on the tax returns. So at the end of the day, cash plus credit plus market rents really equals appraisal. So as long as you got credit, as long as you got money for down payment, we can get you into a property either with market rent or no ratio, as I explained. But those are all options, right? So you don't need to worry about the income side anymore. The other benefit is on reserve assets, and this is where we run into a problem, with conventional. The top part here is the guidelines for multiple properties under Fannie Mae. So if you own 5 to 6 properties and they're financed, that doesn't count if they're paid off, but if they're financed, you got some sort of loan on them, then they're going to look for 4% of the net outstanding balance in reserve assets on those properties that you already own, plus the reserve requirement for the property we're purchasing, plus your closing costs. So I just ran a quick scenario on the bottom and said, okay, we've got 5 properties. We're assuming we're buying a $300,000 investment property. We're putting 25% down. If we were going conventional, we had 5 properties with an average balance of $250,000 each. We're looking at a reserve factor of $50,000 plus our down payment, which puts us at about $110,000. I didn't put the closing costs in there. So that's just down payment and reserves, $110,000. If I go non-QM and my payment is $2,800 a month, I'm typically only looking for 6 months reserves on the subject property, no additional reserves. That puts me at $16,800 for reserves and $60,000 again for the same down payment, $76,800 needed, a difference of $33,200. So as investors accumulate more properties, it becomes more and more difficult to qualify for both reasons, both income, because we typically have losses on those properties, or break even because we're trying to minimize that income, and or additional reserve requirements that make it, difficult for those investors to meet. So those are the 2 big advantages of, how you can leverage non-QM loans, really, assets, avoiding the, eliminating the personal income, utilizing just rents and no ratio products, et cetera. So, I'll just open it up for questions now. Hopefully that kind of made sense. I know we covered a lot in a fairly short period of time, but more than happy to kind of dig in and answer any questions you guys might have. Nobody? Let's see. You guys all might be muted. Are you able to unmute? Let's see. Kathy, you're right. Does Nexa work with business? I'm going to go through. I guess there's some questions on here. Let me answer on the chat. Okay, not familiar. Looking forward to learning. Does Nexa work with business credit, EIN, instead of personal credit? The answer is yes. I do have ITINs, or I guess you're saying business credit EIN. I'm not sure about that, to be honest with you. ITIN, meaning individual tax ID numbers for foreign nationals, yes. Employment ID, if I'm understanding that may be where you're going with that. But we do have to have a social security for those, and you have to have some sort of work sponsorship typically to get into those type of products. All right, I don't see any other questions. I'm very looking forward to. Okay, I don't see any other questions online. Are you guys able to unmute yourself, or do we need Sarah or Jason to jump back on here? Can anybody type in the chat? Okay, can you give us an example of how we might use this tool with a client? Are you a realtor?
Hey Matt, can you hear me?
Yes.
Okay, good. Yeah, I asked that question. So yeah, I just mean so if I'm a property manager, um, and how would I approach a client with this? Like, what are some scenarios that we might, talk to a client who maybe they own two homes now, um, they want to expand their portfolio, they have concerns about financing. How would you talk to them?
Yeah, absolutely. I think, the best way for property managers to potentially grow their doors is to, get their current clients to purchase more properties, right? So it's a great opportunity to speak with them, really just educate them. I would just bring it to their attention and say, hey, maybe we put together some sort of flyer or something you could share with them or an email. But just really education. Are you familiar with non-QM loans? Do you know you can purchase an investment property with no income documentation, no tax returns? Because a lot of people, especially investors that aren't 100% versed on these products, they still think, oh, well, I need tax returns. And guess what? My tax returns the last couple of years have been bad. Maybe COVID hurt them. Maybe they're still recovering for some other reasons. They think they can't purchase, but in reality, if they have cash and credit, then they can potentially purchase. I mean, all we're really looking at again is cash, good credit, and then depending on the scenario, whether we're looking at rents or business bank statements that would potentially alleviate tax return stuff. So I think it's more of just an informational or educational piece to make sure they're aware of it or to start the conversation. Does that make sense? I think they might have muted.
Yeah, it does. Thank you.
Yeah, I'm happy to put something together or collaborate with you if you want to kind of, discuss what we might be able to share. But I think it's just it's a piece that you can put out there to, start the conversation. All right. Are there any other questions? I didn't see anything else online.
You else have any other questions? Or maybe can you get a copy of this? Yeah, this is recorded, so we will definitely have a copy of this because I know there was a lot of information covered quickly. Sarah, do you have anything to add or an example? Like we did a DSCR loan for the rental property I'm sitting in right now. I'm actually visiting our Airbnb to make sure it's like checking it out. And Matt helped us with the loan on this because we didn't want it attached to our social security numbers. We didn't want it attached to us. We already had some loans and stuff in place for our own personal property. We wanted this to be a business and to be separate, like a lot of your investors might, to protect and insulate ourselves. And so we wanted to do this through a separate entity and have it linked to that EIN number and not be directly linked to us for liability reasons, right? And a lot of your investors will feel the same in property management, I would imagine.
Yeah, typically as investors accumulate more properties, then the CPAs start talking to them about putting them in an LLC. Has kind of been my experience with it as well. In some cases, if there's just like a one or two off properties, it depends on the CPA as well. But sometimes it seems like as they accumulate more properties, that's when the CPAs start pushing them in that direction, and that's where you get more. I get communication on how do I do this or what's the best way to do it.
Yeah, I think one of the things to kind of keep in mind is if you are an investor or if you have clients who are investors, many of them would be very happy to do more deals, especially if things are going well. If they own one or two or a couple already and things are going well with the property, it makes sense oftentimes to continue to add more so that you can continue to build your portfolio and grow and add wealth that way. So if you have an investor client that has, let's say, one property and you're managing it for them, it's worth checking in with them and saying, hey, how are things going? And doing like a little portfolio review. In that review, I always like to ask, well, hey, it really seems like things are going well here. The property is performing well. do you think it would make sense for you to add another property to your portfolio? And oftentimes they may not have even come to that conclusion on their own. They may need a little bit of a bump or nudge. And sometimes they're very, very hungry to get into properties and they would love to get into more properties, but they either don't have the cash flow to come up with a down payment, or maybe their credit isn't amazing. They might be maxed out on the debt to income ratio. It might just not be something that the traditional conventional loans can really help them with. And for that reason, they might just feel like they're stuck. I would love to get more properties, but I can't make it happen. And these are the reasons why. There are always creative ways to get into more properties. And these are some of them, using and leveraging other people's money, which I love. I love not having to pay for like the mortgage on it, because your tenants, when it's rented, they're paying the mortgage payments for you. So I almost don't know anything else that you can build wealth and have somebody else make your payments for you, right? So it makes so much sense to continue to build your portfolio. And a lot of times, property managers, investors that I talk with, they don't know that these are options. I always know that there's a way to do something. I just don't always know what the way is. But I know it must be possible, right? Because other people do it. I just don't know how to make it happen all the time. But these are some options that you can go, oh, well, I know what I want to do, and this is a way that I can do it. So, Matt, what are some really common scenarios that you come across?
Wait, I have one that I would like to ask about. So a lot of times investors already have some equity probably built up in some of their properties, and they don't realize that they could use that to buy additional property. And so if an investor's had a property for a while, maybe Matt or Sarah could touch on what a cash out refinance might be, how there may be some equity in a property, or how their current investor clients may not need to sell a property in order to get into a new home or into additional property. There might be another option where they could keep the existing home, and especially accidental investors. So could you touch on maybe the cash out refi sort of idea?
Absolutely. So there are a lot of owners out there that have equity, lots of equity over the last couple of years. The challenge really is if there's a loan on that property, a lot of these people have really low interest rates relative to where the market is now. And that's really been the challenge. There's lots of people that would like to access that equity, but when they start looking at the numbers from the current interest rate perspective, it can change some people's minds. Now, in Texas specifically, we have home equity laws that are stricter than most of the other states. So we don't have as many HELOC products or home equity lines of credit that other states have. So if you're outside of the state of Texas, there's a lot more options for these folks, investors, to tap into that equity via a second lien home equity line of credit or HELOan. There's fixed rate products and HELOCs that comes at a floating rate that could be, 8, 9, 10, 11, 12%, depending on a lot of different factors. It's a little bit better than most credit cards, but it's going to be higher than your mental, mind's going to think on a 30-year fixed mortgage. They're typically smaller loans though. So obviously, a $30,000 line of credit payment on that with a higher rates, considerably lower than if you're looking at a large loan. But that's most of the HELOCs are, smaller loans. They could be a little higher interest rate, but it is a way for you to reposition that equity from your current properties to go buy more properties. And depending on the market and where you're located, I mean, we are seeing prices starting to come down a little bit. So it's definitely more of a buyer's market, at least here in Texas. I think our properties are still a bit overvalued, but it is coming down, and there's definitely opportunities for buyers to come in and get sellers to cooperate and pay closing costs. So it's always a great idea. I just, in Texas, it's a little bit more difficult, and there's very minimal resources for companies that actually do HELOCs and HELOans on investment properties.
So Matt, I I want to see if I can get some clarity for people who are wondering is this possible? Do I have some trapped equity? Can I tap into that? Does that make sense? So can you just, I know every situation is different and unique always. So here's your little, I guess, warning is speak to the professionals and see, does this make sense in my situation? But maybe some general rules or guidelines, like when do you see like it does make sense to do like a cash out refi? And when do you feel like, oh man, it'd be nice, but just right now things don't line up and you should wait until this other thing happens?
Yeah, so and I'll speak to Texas specifically here, but the maximum cash out you can take on an investment property is about 70% loan to value, right? So if you have equity, more than 30% equity, and I would say more than 40% because you probably don't want to pay the fees for 10%, but that's kind of relative to what your loan balance is and what your property values are. If you have more than 30% equity, then it's you have the potential to maybe pull some of that equity out. Does it make sense? Well, the question we got to look at from a couple of perspectives is, what is your rent on that property? If we're talking about investment property, we're still going to be able to cash flow. And what's the opportunity or opportunity cost, right? So if you have the ability to go scoop up a new property that's severely or significantly undervalued and you have a deal that, for whatever reason, most money is made in real estate by buying the property, right? So if you can buy a property at a discount and reposition that equity and maybe minimize your cash flow over here on this other side, does it still make sense? It absolutely could. I think it's a sticker shock for a lot of people that have, say even 4% rates on an investment property when they start looking now at, 7, 8, 9% for investment property rates, depending on, the scenario. So it's hard to answer when it makes sense because there's a lot of different factors. Like I said, I mean, it's, if you can reposition it and get a great deal, then, it may be worth it, even if you're minimizing your cash flow on that particular property. It also depends on what your, hold time is on that property. If you're going to sell it in 2 years, then does an interest rate, going from 4 to 7, 8, 9, whatever for 2 years really matter? If you just were able to buy a property that, maybe say had $100,000 equity from day one, you put some money in it, you got more equity. So there's lots of factors. The biggest challenge again is just the rates, the sticker shock of the rate. And then, a lot of times people just say, oh, I don't want to go, negative cash flow or break even. I have a decent cash flow now. And that's where the second liens come in as a great option in most parts of the country. I just caution that we have limited availability here in Texas.
So I think what everybody should probably take away from this is that everybody needs an easy button. They need somebody like Matt you can reach out to so that, if you could set up an appointment with somebody like Matt and your investor client and like, here's what we've got, here's the different scenarios, and you can crunch some numbers, play with some different options. There may be some creative or interesting financing ideas or ways that they can move some equity around or ways that they get into additional loans. And if you're running like something like our ROI calculator or leveraging some of these tools, you may be able to show that in the long term, even if interest rates are high, getting into property now is still better than getting into property later when it comes to investing. Most scenarios where when people actually math everything out, even if the current interest rates are high, which a lot of people freak out about, having more rental property a lot of times will still pencil out as an advantage in the long run over not acquiring more rental property.
Yeah, having multiple properties with that appreciation typically is going to, benefit or show positive return over one property with more equity in it, but, minimal cash flow for sure.
And I think it also depends on what is your strategy. So in Texas here, if you're looking for a property that's going to cash flow, you're not buying anything. At least not right now. It's probably not in Austin, probably far outside of Austin. You can find something. But here, if you're looking in the Austin area, it's just not going to happen unless you come across a crazy stellar deal. It's probably not going to be on the MLS. It'll be like someone's grandmother is selling it, and do you know anyone who'd be interested? Something like that. So if you're looking for cash flow, that's something that you need to kind of keep in mind. It's also to keep in mind though that there, aside from just does this property cash flow, what really are the benefits of owning a rental and an investment property? So cash flow is a part of the puzzle, but it's not always the biggest piece. So you're getting appreciation on the value of the property. You're getting depreciation of the value of the property on your taxes. You're getting your loan pay down. Essentially, your tenants are either paying some or all of the loan for you, but you still get to claim the interest as a tax write-off, which is great, even though essentially your tenants are paying that for you. You're getting a bunch of other tax benefits that otherwise you probably just would not be able to get, and you're building equity. So real estate is an amazing thing. It doesn't always have to cash flow. You just have to kind of keep that in mind. So if cash flow is a thing and you're like, I cannot do this, I can't like front, $500 a month, that would like break the bank, that would drain everything, then don't do it. Like wait until you can find a property that the numbers make sense on. And the way the market is right now, you might be waiting, and that's okay. Or you might need to partner with someone, and that's okay too. But a lot of times the clients, Jason, that I hear is, oh, well, like they have this property and it won't cash flow, so I'm going to sell it. It doesn't always have to cash flow. And if that's the only investment property you have, or if you decide that you have a bunch of them and none of them are cash flowing, so you sell your entire portfolio, you really need to, before you make decisions like that, sit down with your CPA and say, hey, if I sell this property, what happens to my taxes? Because odds are you're going to pay more in taxes because now you can't take the losses. So these are all things to kind of keep in mind. Cash flow is part of it, but there's a whole bunch that really goes into the equation. And this is one of the reasons that we really need a great CPA. We need somebody who understands real estate and who understands the inner workings of the tax code and how it's written and how you can benefit from it. A lot of CPAs, they have no idea. They're trained on one area, they're trained on one thing, they know how to do what they know how to do, and they don't like to stray outside of the lines. They don't like to try to figure out, well, is there, this different strategy we can apply? Some of them are very, very conservative, and some are a little bit more aggressive. So you need somebody, a great CPA who really understands all of these things, and then you need somebody who understands how to structure a deal and make it work with the lending and the financing. So if you have those two pieces of the equation, you're so far ahead of where most people are. Because I know if I had a deal and I called Matt and I was like, hey, Matt, here's the situation. Like, does this make sense? Can we make it make sense? He would be able to tell me, oh, well, we can either do this or we can do this. He would give me a couple different options. And if we go this route, it's going to look like this. If we go this route, it's going to look like this. Or Sarah, it's just not like, I can't make it happen. Like, if this is what you're looking for, I can't make this happen. This is how we have to do it instead. So once you have somebody who really understands the inner workings and does deals specifically with investors, that's a fantastic connection to have. So that's why we wanted to bring Matt on the call today, is so that you guys have somebody that you can connect with and ask questions to, like this. Like our rental property, that was a weird one. It was like 3 different things that we were using it for. So, right, but I'm like, okay, so here's the situation. Here's how we're going to use it. There's going to be some DoorGrow events there. We're also going to use it ourselves some of the time. And then for that reason, I can't long-term rental it. Can't have a long-term rental where once a month I tell people, hey, get out. I have to use this, so get out. It must be a short-term rental. So how can I make that make sense? It was really great. I can honestly say it was great working with Matt, because I could also tell you, Matt, I never talk with people I got off the phone with Matt, like our first conversation was like 47 minutes. I don't talk to people that long on the phone. I don't. I got off the phone with him. Jason's like, who are you talking to that long? I was talking to Matt because we were talking about different ways to structure the deal and all of the different loans that are available that most people don't even know. And the first thing I said to him was, once we wrap this deal up, can we get you in front of like our clients and our audience? Because there's always a way to make a deal happen. You just sometimes have to figure out what it is. And if you have somebody that can point you in the right direction, like Matt can, oh man, you're golden.
And there's a big opportunity here because we switched real estate agents because our real estate agent, while we were looking for property, for rental property or an investment property, we asked, can we do this under an LLC? Can we not have this connected to us? And the answer was, oh no, he only knew about QM loans. And so he kept trying to push us that way and push us to his typical lender, the same one we use for our personal home. And we were just like, Sarah's like, no, there's got to be another way. And that's eventually asking around what led us to Matt. And so that agent lost the deal. And if you're the property manager and you do the deal, you may lose credibility if you don't understand or at least have a resource to connect people to. And one of your investors catches wind. Oh, well, I could do a DCR loan maybe for the short-term rental that I want to get, or I could do this other thing, right? And so you need to be able to have in your back pocket. And not everything's going to be about, a lot of investors might be focused on the wrong things. They might be focused on, in the short term, they're worried about interest rates. But that there's also advantages when interest rates are high. The market stabilizes, property or it comes down in some instances. And so there's deals that can be made. Refinancing could maybe be done later. If there's deals that could be had because some properties had trouble selling, like this property had trouble selling. It was on the market for a while, so we were able to get a decent deal on it. And that in the long run is going to benefit us. And yeah, we'll probably refinance it once interest rates drop or something. But if you have investors that you can shift from the short term to looking at the long term, then things get even more creative and they're making much better decisions. And so you could be looking at, tax benefits, or maybe they're trying to just diversify their portfolio. And, if they're focused too much on interest rates, the investors might miss the benefits of holding, real estate in their portfolio and go buy other assets or spend their money elsewhere. And then you're cut out, like you're the property manager and they're going and buying stock or something like that, which may not even perform as well in the long run. So no stock is always up or has a great rate of return initially, generally. And so if you believe in real estate, you should be able to push people towards it even when the interest rates are high, right? And there's other, benefits or other things you could probably identify during high interest rate seasons and turn it into an advantage if you can get creative. So, all right. Anyone else have any questions before we give Matt his valuable time back?
Well, let me just say thanks for the kind words there. And I agree with you wholeheartedly, or 100%, that a lot of investors do get stuck on that cash flow piece. And it is definitely a challenge in Texas, and specifically in Austin, Texas. But I can tell you that over the years, the appreciation in Austin versus some of these other markets has been so good that I've seen investors come in and be like, well, I'm looking at, this market in Austin, but I can't get cash flow in Austin, and I'm a little concerned about that. And they go invest in some of these other markets. And if we look at it 3, 4, 5 years down the road, I can tell you the people that actually bought in Austin have done very well with appreciation. And a big part of that is the job market here. We have a very strong job market, a tech market. You've got, Elon with Tesla and all that, but there's still lots of jobs coming to Texas. And specifically to Austin. Now, that might be shifting a little bit because of the prices. I mean, we're seeing a lot of move up in Dallas right now, and even San Antonio see some of that. But the appreciation has been really, really good here. So sometimes I agree with Sarah, you got to get off of the cash flow. As far as being positive or net positive, like, hey, I'm going to make a bunch of money off this property immediately. It may take you a little while to get to that net positive, but if your tenant is paying 100% or even 90% and you're getting the tax benefits and you can restructure that loan in a couple of years, it still could be a great investment, especially if you're able to buy it, right, and get a deal on it when you purchase it, et cetera. So you know, with long-term investments in Texas or long-term rentals in Texas, it's difficult to cash flow. When you talk about short-term rentals in some of these markets, that's a different story. It really just depends on where the property's at, but the return on, you know, short-term is great too.
Yeah, and Sarah geeks out on all the tax stuff. So even if you're like losing out on cash flow or money on a property, there's tax strategies that you can leverage to offset that. So
Well, yeah, that's the challenge that we run into unconventional, right? The tax strategies are minimizing that income, showing losses, showing minimal income, and that's why we run into problems on trying to get qualified mortgages or full off conventional loans, right? And so that's why, you know, this is where non-QM comes in, but you still get the tax benefits with non-QM. It's just a way to help us get you qualified and get into those properties that you wouldn't necessarily be able to get into.
cool. Well, awesome, Matt. We appreciate you hanging out here with us and sharing some insights. And my challenge to everybody here is make sure you have somebody. You can reach out to Matt. If he can't help you, I'm sure he can connect you with somebody who can. But make sure you have somebody in your back pocket that you trust with a high level of expertise that can help you figure out some creative you know, situations or some of your challenging situations with your investors. See if you can get them into more investments. And that's just going to showcase more expertise, and you know, by bringing in good partners like that, and it's going to help you hopefully get some more clientele and more rental properties that are in your portfolios.
Hey, real quick, let me jump in. I know somebody's asked for a copy of this. More than happy to share it with you guys. So just if anybody wants to email me, I'll get you a copy of this. And then also just use me as a resource. Anyone out there, regardless of where you're located, what state you're in, you know, more than happy to have a discussion and try and help you in any way that I can. Or, you know, if you want to collaborate on some pieces that maybe can start that conversation, I'm open to that as well. But the bottom line is just use me as a resource. I'm always available to try and help you out.
All right.
Awesome. Thanks. And then I think the last thing that I'll add is even right now, market is a little challenging, and it's in certain areas, it's holding decently steady. In certain areas, it's starting to dip a little, and in certain areas, it's starting to dip a lot. But right now, even though the interest rates are really high, it's a great time to buy, especially if the property values have dipped a little bit. So in Austin, I mean, like they're holding decently steady, but they have certainly dipped. Like we're no longer in the area in which you list a property and within 2 days, you have multiple offers that are hundreds of thousands of dollars over the list price. We're just not there anymore. It's not that it doesn't ever happen. It's just that it's not the norm on every property and every listing. So when things start to slow down and prices start to dip a little bit, it's a fantastic time to start to pick up a property, even if the interest rate is high. Trust me, I don't like paying like an 8 or 9% interest rate. It's not fun. However, if I can get a property at a lower price right now, and then I can hold out until the loan changes. So when those interest rates change, if I can do a refinance, I figure it this way. If it makes sense at the higher interest rate number, it's going to make way more sense at the lower interest rate number. So as soon as those interest rates dip, it's even better. So right now, if your market is kind of slowed down a little bit, sometimes property managers and real estate agents, they start to kind of panic and they're like, oh, this is not good. It's a great time to buy. It's a great time to buy if you can make it make sense.
Very cool. We kind of did both. We've got one property with lower interest rates, and then the next property was higher interest rates, but you know, we were able to get that at a discount, and our previous one has dipped in value significantly since interest rates have gone up. So it's interesting. Generally in real estate, if you keep getting into real estate assets, you're going to keep making money in the long run. It's one of the most stable, effective assets, and I'm sure you're all believers in that. All right, then with that, we'll go ahead and wrap this up. Until next time, to our mutual growth, everybody. And thanks again, Matt.
Hey, thank you very much for having me. I appreciate it.
Thanks, Matt. See you later.
All right. See you guys later. Take care.